I still have some clients that believe that you need 20% down. How would you help them out?
Well, that 20% down really comes back to mortgage insurance. And everybody wants to avoid mortgage insurance. It's an extra fee that helps the lender more so than it helps you. However, depending on whether they qualify FHA or conventional, you can do as little as 3 to 3.5% down. Absolute worst case scenario for primary residence, you can even do 5% down if you're already a homeowner and trying to go that way. Not to mention there's programs through the VA where you can do 100% plus financing, or if you fall into the right income limits and the home that you're looking for is in the right area, you can even do USDA, which is 100% financing. So there are lots of options out there to get you in well below that 20%.
Sounds good. I know that's very important because, you want a house, but you also want to be able to qualify. So
Absolutely.
I have a lot of people ask me, what's the difference between being pre-qualified and pre-approval?
Okay. A pre-qualified person is somebody who we've had a conversation. I may or may not have been able to pull credit on them, and it's a lot of assumptions in it. The CFPB, the group that protects consumers out there, is actually very picky about the wording on a pre-qualification versus a pre-approval. And once again, a pre-qualification, there's a lot of assumptions, nothing's verified. With a pre-approval, I have pulled their credit, I have received all their income documentation, their proof of their ID and such, and I've actually sent them to underwriting, and we've started the process of actually underwriting that client to make sure that they really are approved. It's not a guess, it's an actual approval.
Gotcha. So there's quite a bit of difference.
Absolutely.
What does a typical mortgage payment include?
Well, the standard is principal, interest, taxes, insurance, and homeowners association dues. Now, most people don't actually include the homeowners association dues in their monthly payment, but when it's calculated, that'll be calculated into the mix to make sure that you can afford the home. There can be additional things if you need it. In Florida, we have a lot of homes that have what they call a CDD, which is a tax, and things like that can be added into the mix. But generally speaking, most people reference it as principal, interest, taxes, and insurance.
Okay, makes sense. What is an escrow account?
I get a lot of questions about this, and a lot of people get a little upset that, I'm giving all this money to the bank. This is actually your money. It's an account that's set aside for you, and you put money in every month so that you don't get a giant tax bill and a giant insurance bill every year at the same time. That way you're putting it away monthly, and it's a lot more affordable to most homeowners. That money is set aside. Now, at the end of the term, when you refinance or when you sell, that money's yours. So any of the money that doesn't need to go to taxes and insurance, that money's yours. It comes back to you.
You're not taking people's money.
Absolutely not, and neither is the lender in this case. And for some borrowers, if they're in a good enough financial position, they can avoid the escrows and pay that bill themselves. But that's going to be a conversation that you're going to want to have to make sure that they're in a good enough financial position to be able to handle that large bill every year.
Well, how long does it typically take to close on a loan?
Well, once again, it all depends on the scenario. Most of the time right now, we're closing in 30 days or less. There are certain scenarios where, things might take a bit longer. For example, if you're doing a construction loan or a renovation loan, you are not just qualifying your borrower and the home, you're also qualifying the budget and the build. Or if you're doing a reverse mortgage purchase, those tend to take more like 60 days. Because the process is a bit different and there's counseling involved and things of that nature. So generally speaking, for the majority of borrowers out there, we can close in 30 days or less.
That's not bad.
Not at all.
This is, to make sure there's a range. What is the typical closing cost on an average price house in Orlando?
Well, there's a lot of factors that go
I know,
into
that's what I was going to say. It's like asking what the price of a car is, I guess.
Yes. So there's factors that impact that. I guess the first one that everybody wants to know is, my commission. Okay, so that impacts it. I can be paid by the borrower.
I seen you drive up in a Ferrari, so I'm like,
Yes. It was a Toyota Tundra Ferrari. Yes.
okay. Okay.
And so obviously I can get paid directly from the borrower, or I can get paid from the lender. And if I get paid in the lender, that means a little bit more in their rate, but it does mean less fees on the front. Now there's other things that impact that. Your taxes, your insurance, flood insurance, things like that all roll into it. Those things also become what they call prepaids. Now that means that prior to being able to get into the home, you have to have a escrow account set aside, a large chunk of money set aside, so that they are prepared for those insurance and tax payments when they're due. The closer you get to November, generally speaking, the higher that number is, because November's our tax date here in Florida. Those things can impact it.
So there's a lot of variables.
Absolutely. And once again, it could also depend on your loan amount, or not just your loan amount, but your loan structure. So if we're doing an FHA loan, they require an upfront mortgage insurance as well as a monthly premium, and that will get impacted on your closing costs.